Hello, friends. Joel Garris of Nelson Financial Planning here, and you're joining us for another episode of Dollars and Cents, Central Florida's longest-running radio program. On the program today, as we do each and every week, we're going to obviously have some open lines for callers at 407-916-5400, toll-free 1-866-916-5400. Or if you prefer, you can also send us an email. That email is Joel, Joel, at nelsonfinancialplanning.com. So that's how you can get in touch with us on the program and add your topic to today's show. On our program, we're going to be talking about whether lawyers, in fact, control how your investment allocation is set up. We'll have some thoughts on that. We're seeing that kind of more and more, particularly among the larger financial services entities, where the lawyers, in fact, are the ones that are driving what the advisors can actually do. We'll talk a little bit about that and explain what all of that means for you and your money. Also, we'll be chatting a little bit about expenses within, particularly on the annuity side of things. It may fascinate you to hear the numbers. We've certainly, in prior episodes, talked about them on the program. But when you start to look at the level of guarantee that you're getting from the annuity or the supposed guarantee, we'll talk more about that too. The reality is that you are paying for that at a much higher rate. And when you start to look at the numbers and compare how much the underlying expenses are that you pay each and every year when you own a product like that, and compare that to whatever the interest rate is that the annuity is offering, well, guess what? You can see very quickly why the insurance company is able to offer that, because they're making up almost all of that in the expenses that they charge you along the way. We're doing the video forecast, the video podcast as well. So on the video monitor, which we'll of course go through and edit and post tomorrow, so that you can catch us during the course of the week, or if you missed a part of the show, or you just want to see me, hey, I'm waving at the camera, then you can certainly do that. This week, we thought we would go with the Patriots tie because, after all, it's the start. Well, I guess it started technically on Thursday, but today marks the official kickoff for the full slate of NFL games. So only appropriate as a young boy from New England because that's, after all, where I grew up, only appropriate that we should be sporting the Patriots tie. In case you missed it, they are also the defending champions too. So anyway, so let's begin, shall we? So one of the things that we constantly hear as we talk to folks in the industry is the role that compliance departments are playing at financial services firms across this country. And what that really means is that as an advisor, or as a planner, or as a fiduciary, or whatever the name is that folks want to describe themselves as, the reality is that there is still in the background a compliance department that overlooks everything that happens in a financial services firm. That's how the financial industry is set up. There is always a compliance department that has a number of rules, a number of restrictions, and a number of things that you can do and a number of things that you can't do. And it's the can't do part that is obviously there for investor protection, but a lot of compliance departments, which of course are run by lawyers, so I've got a little bit of a background in that prior career in a different lifetime. The reality is that the lawyers are going to create restrictions or parameters in which the advice can be given in such a way that it stays within the particular channel. So if you are a lawyer and you're looking to minimize liability, whether it be to your regulator or to your clients, what's the best way to do that? Well, at the end of the day, it winds up being much more of a conservative nature, much heavier on the more conservative side of things, much heavier on things like cash and bonds than you might otherwise see, because the lawyers which run the compliance are basically restricting the overall allocation that someone can suggest to somebody. That's why when you look at target date funds, even the target date funds that are out like 2060 and beyond, they still have a 10% allocation that's cash and bonds. Well, that's kind of silly when you stop and think about it, because if you're really looking for a pure growth perspective and you've got a time allocation that's out for 40 years, why bother to have a 10% position that's in cash and bonds? Oh, the reason is because the lawyers said that you had to, and the compliance folks said you had to. Here's the problem with that. What we're seeing across the board is that more and more investor allocations are being done with a much more conservative slant. Of course, the problem with that in today's world is when you have incredibly low interest rates. I've been getting the question of late, how can all of these bonds out there, all this government bonds be out there and be at negative interest rates? Who on earth is buying that? And you have to think about that, because if you're going to make an investment in a bond and you're going to get a negative interest rate, then that means you're going to lose money. But yet there's 13 trillion of that type of debt out there. So who on earth is buying it? Well, that's where you have to get into these concepts of lawyers and compliance departments, and the fact that many investments, many guidelines have a set amount that must be invested in a particular way. The real problem is when it comes to your money, right? If the lawyers or the compliance departments are determining exactly what the range of your investment allocation can be, and the current economic and investment climate, particularly on the bond side of things, necessitates that you have to own X percent, well, then how is that to your benefit? So ask the question the next time you're visiting with your financial advisor. Ask the question, who's your compliance department? Where are they located? Are they located in the same location, or are they in a different location? Are they controlling what flexibility your advisor has in particular? And are you winding up owning investments because the lawyers say that you have to own a certain amount of investments, but yet it's a negative return? Stop and think about that. And some important questions to ask, particularly when it relates to your money. Watch out for the lawyers, because they have a greater control over what your investment allocation looks like than you realize. We'll take a break. When we get back, we will continue the conversation and turn our attention to another one of our hot button items. So today may very well be a hot button show for us. The annuities and the cost of annuities, and how much that expense is costly to the end investor. You're listening to Joel Garris of Nelson Financial Planning. This is Joel. This is Dollars and Cents on News Radio 93.1 WFLA. Welcome back to the program, segment 2 of Dollars and Cents. This is Joel Garris of Nelson Financial Planning. And in this segment of the program, we're going to shift gears and talk a little bit about some of those costs that folks just don't realize when we think about an annuity. Before we slide to that topic, though, another follow-up to some of the comments that we were making in that first part of the program, interest rates being as low as they are. A couple of years ago, when people were getting 30-year mortgages at 4%, I thought to myself, my goodness, that's just incredible. That you're never going to see those rates get any lower than that. I mean, imagine borrowing money for 30 years and someone's willing to do that at 4% on a fixed rate basis. That's just incredible. Well, if you're not checking out interest rates of late, you'll find that they have gone down much lower than that. And today, your average 30-year fixed rate mortgage is about 3.6%. So not sure if that's really worth refinancing and going through the cost if you're at 4 to try and get down to 3.6. Probably not, because there's usually a cost in there. But just amazing when you stop and think about how low that interest is and how you can borrow that over an extended time. That goes directly to the fact of why would you want lawyers in a compliance department telling ultimately what your overall investment allocation must include. You've got to be able to adjust that and to have the full range of options and not be so restricted. So really, from an investor, you've got to ask those questions about where the compliance department is and how much they control the room that your advisor or planner has to work with. Some pretty important things to be thinking about with your money, particularly now when you look at interest rates and bond yields as low as they are. 13 trillion in negative yield government debt out there. Man, I'm not sure I would want to have any of that. That's for sure. But many have to. And that answers the question that we've been getting a little bit of late was, if there's 13 trillion of negative yielding debt out there, who's buying that? Who on earth would do that? And the answer is there are many institutions that require certain levels of certain types of bonds. And that's why you still see the demand out there. As crazy as that is the concept. Speaking of crazy, we'll shift gears to an annuity, which, as you know, if you've listened to this program, we are, simply put, not big fans of the fine print associated with that, because with that fine print comes an awful lot of costs to investors. You hear the ads, right? 5% guaranteed income, all of those types of suggestions that are made out there. A couple of points to consider. First of all, when you hear these pitches on this 5% income riders, that they're going to generate out 5% income, that doesn't have anything to do with the value of your account. The 5% income rider has to do with the percentage that the insurance company is going to use to calculate how much income it's going to distribute to you over the course of an extended period of time. So that has nothing to do with the rate of return. That has everything to do with the fact that they are generating out income. That income, of course, includes some profit, but it also includes the return of your original investment. That's why I love whenever I hear these annuity conversations and they talk about the rate of return. The rate of return, they always somehow include the amount that you originally contributed as that's part of your rate of return. And that's got nothing to do with your rate of return in any way, shape, or form. But yet, all of their explanations and numbers typically include the distribution back to you of your own money as part of the description of what the return is. And folks, that's not rate of return. You getting back your money is what's supposed to happen. That's not a profit on your money. Here's even the worst thing about those. When you start to look at, and we just looked at one this past week. So obviously, we come on here Sunday morning and we think about, okay, here are the things that happened this past week. Here are the headlines. And what do we think is important to share with our listening audience that still continues to be an issue that we see on a regular basis? And this annuity stuff is right at the top of the list. And so we went through this with somebody this past week. They had invested in this annuity several years ago with the notion of it being a 5% income benefit. And again, that just simply means that that's the percentage number that the insurance company is going to use to generate out the income. That is what determines how much income the insurance company is going to generate. That has absolutely nothing to do with the value of your account. What it also has nothing to do with is how much the internal expenses are when you start to add them up. Because, see, in an annuity, there's always 3 different types of expenses that you've got to add up. First is the underlying expenses of the investment subaccounts. Okay, every one of those is going to have a baseline expense. Traditionally, that's somewhere between 70 to 1 full percentage point. So 0.7% to 1%, that's item number 1. Okay, item number 2 is the actual sort of insurance contract itself, the costs associated with that. Usually that's referred to as mortality and expense. M&E is another way to say it. They may also have an admin wrapped up there in there as well. That traditionally is anywhere from 1 to 1.25. Okay, and then come the bells and whistles. The 5% guaranteed retirement income benefit, the all of those bells and whistles. And those bells and whistles add another 1%, give or take, to the total cost of the contract. So let's add them up. I got investment expense of 1%, I got M&E at 1.25, and I got my rider. See, when you sign on to an annuity and you have some super special 5% benefit, you pay for that. That's an additional cost. That's a rider cost that comes with that. So if we add up the pieces, 1% for the investment, 1.25 for the M&E, and 1% for the rider, guess what? You're at 3.25. How good's that 5% looking? Especially when that 5% includes the payback of your original investment into the product. Folks, that's how the engine on those annuities works once you lift up the hood. And once you lift up the hood, you realize very, very quickly, or you should, that the expenses that you're paying only serve to benefit the insurance company. And ultimately, that's how they're able to do what they're able to do, because they're fully making it back from you off of your money over time. Beware of it. Ask the questions. Don't just settle for, oh, don't worry about it. The insurance company takes care of it. You've got nothing to worry about. When somebody says you've got nothing to worry about, that's when you need to start worrying. And you need to start asking the questions and independently verify and do your own research on it. Because oftentimes we see situations where people did not get all of the information that they should have gotten. Certainly not to the point where they realize, hey, wait a minute, this thing's costing me 3.25% per year? How is that going to work? And the answer is, it most certainly does not. So be aware of that. Make sure you're asking the right questions. If the answers start to get evasive, then time to move on. And particularly if you're thinking about one of those annuities, I would say the time to move on is right from the very beginning of the pitch, because The numbers just do not work. That's how they add up, though. You have to understand how the numbers add up and where they come from and how they calculate it. It is very misleading to assume that a 5% income benefit is somehow going to equate to an increase every year of 5% of the value of your money. That's not how it works. Anyway, hopefully some good information on that one. I know we've certainly talked about that in the past, but we keep seeing it. So we know it's still out there, and it's important that investors know to ask those kinds of questions. We're going to slide to a break. During the break, we're going to have open lines here at the Clear Channel Studios at 407-916-5400, toll free 1-866-916-5400, or you can shoot us an email. That email is Joel, Joel, at NelsonFinancialPlanning.com. This is Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA. Welcome back to the program, ladies and gentlemen. Joel Garris of Nelson Financial Planning, listening to Dollars and Cents here on News Radio 93.1. Next up on the program, we're going to talk a little bit about target date funds, just how many are out there and what their performance was for last year. Some interesting statistics on that for what has become an ever-increasing popular option among investors, particularly within 401k platforms and the like. But before that, we'll slide to the phones. We've got Bernie with a question on some index life insurance, which is another one of my not favorite topics, but go for it.
All right. Well, I appreciate the discussion on annuities. And so the Index Universal Life is also another product that I keep hearing about. And they're saying that, well, you can overfund that, insurance payment, and then that gives you a good way to invest money and get it back later. And so I was interested in your thoughts on that product, which you've kind of preambled a little bit for.
Yeah, not to give away my answer before you ask the question, but so here's how those concepts work. So when you talk about a life insurance, because a life insurance policy funding is going to be a little bit different than what we're talking about on the annuity side, but it's to a certain extent somewhat the same concepts. On the insurance side, what you're doing there is you're basically funding it early, and with the notion that over time there's actually going to be some underlying growth, and then when you get to retirement, you're able to sort of borrow that money. And the pitch that you always get when you're talking about these insurance types of policies is that you're able to borrow the money tax-free because it's a loan. So it's not a withdrawal out where that would generate some taxable income, but you borrow the money. Of course, here's the problem with borrowing the money on a typical insurance policy. What you'll find is that they're going to charge you an interest rate, just like any other loan. And typically that interest rate is a bit higher than the interest rate that you're actually getting on the insurance policy itself. So the reason I don't like them is a little different than sort of the annuity option. The notion that I'm going to borrow money out of the policy, but yet they're going to charge me interest on my own money just so I can avoid taxes, that kind of doesn't sit well in my stomach, if you will. The other part is the index part. And Bernie, the index part is even kind of a little funkier, if you will. There's a lot of fine print on when you're talking about indexing as it relates to insurance products, whether it be a life insurance product or an annuity. One of the biggest tricks that the insurance industry does on the indexing is when you compare to the market. So they talk about, we're going to index this to the market. And when the market goes up, you do great. And when it doesn't, then you don't lose money. The problem is that they've figured out a way to really compress whatever the return is that you're potentially going to get. One of the biggest ways they do that is by eliminating the impact of dividends in the market. What most people don't realize is that if you look at the performance of the market over time, nearly half, it's actually 44%, comes from the impact of dividends and reinvesting dividends along the way. Well, if you're going to index me to something and then eliminate 44% of what the potential return could be, as you can see, Bernie, you start to get those numbers pretty compressed pretty quickly.
Okay. Yep. So they still have a way to get the money back then.
Oh, no question at all. The insurance companies generally do very well on these annuity and life insurance products. The problem is that if the insurance company's doing well, that means you, the investor, aren't doing as well. Yeah.
All right. Well, thank you very much. I appreciate that.
All right. Great question. Right on point to the conversation, and we certainly appreciate the call, Bernie. Yes, the index stuff is even more funkier than even the some of these guaranteed retirement income benefits that are out there. That is that's for sure. So great question. We certainly appreciate that, Bernie. Speaking of things that have gotten a host of attention of late, that is these target date funds. And we were talking a little bit about them in the first segment of the program and just how much the overall allocation of those funds is in fact determined by compliance departments, i.e. lawyers, that make sure that even a target date fund that's way far out, let's say a 2060 fund, typically is going to have a 10% allocation that is in cash and bonds. And if you're looking for something where, hey, I want a pure growth approach, I'm not sure it makes sense to have a 10% portion in that. What's the point of that? This is your retirement account. That's typically where you see these target date funds occur. And it's not like it's your account where you might have to grab some money out of it in order to meet emergency expenses or the like. So at last count, at the end of 2018, there was a total of 652 target date funds that existed. 652. Isn't that amazing? Here's the even more amazing statistic. Every single one lost money for calendar year 2018. What's amazing, though, is that even with that track record, they still are garnering a tremendous amount of money. So far this year, the first 7 months, target date funds brought in an estimated $36 billion of new dollars. Why would that be the case? That they're still able to generate in that much interest, while yet at the same time, every single one of them lost money. Not only did every single one of them lose money, if you look at the average return for those funds, for last year, 2018, it was down 6.2%. The overall market, down only 4.4%. Pretty dramatic in terms of what the results were. So, what's going on there? I think what's going on there is the fact that from a psychological perspective, when you have a target date fund, it forces you to think about the whole picture. And that's one of the things that I think cost investors the most amount of money is when they get too fixated on exactly what's going on a particular investment or a particular fund or a particular account. And they lose track of the overall picture. But what's fascinating about the psychology of the target date funds, and it really is a psychological phenomenon, because when you look at the actual performance, every single one of them lost money last year. And not only did they lose money, they lost 50% more than the overall markets did, on average across the universe of target date funds. Why would something like that still be attracting the kinds of dollars that it attracts? It has to do with investor psychology. And the reality is that those funds, because they're prepackaged, you don't see the piece that went down 15%. You don't see the piece that went up 15%. It's all packaged inside of one fund. And so that helps to make the results look what they are, rather than causing folks to look at the individual pieces. It's human nature to look at an investment portfolio and say, oh, that fund made 15%. I want more of that. Or that investment lost 15%. I don't want any of that. Well, a target date fund, because it's just a one fund, it has all of those different pieces in there, but you don't see them individually. And so what's fascinating on these target date funds and some of the early results, and certainly if you look at performance and dollar flows, is that people are able to stick with those funds more because of the psychology of the fact that all of the different investments in there are one big picture, and it allows people to see that full picture rather than get fixated on some of the individual components that make up a portfolio. And that's fine and that's good, but I guess my reaction is, well, why wouldn't you want something that was designed a little bit more specifically and then just use the same psychological approach? Look at it as a total perspective rather than an individual perspective. Some interesting comments and observations on target date funds and how that relates to investors, specifically as an investor trying to maintain that overall perspective. That's what those funds do great, is they force investors to maintain that overall perspective, because you can't see the individual pieces that, whoa, this one's doing great, this one's not. It forces you to look at the entire perspective. And so in that regard, I think that's an important takeaway when it comes to your entire investment portfolio, is look at it from an overall. Don't get too hung up on the individual pieces, because that will cause you to make decisions that aren't going to be in your best interest. But certainly a great example where the psychology of being able to look at the entire picture is trumping the results in terms of the actual performance of the investments. Some interesting stuff. We got to slide to the break. We see Skip. Hang on in there for just a second. We'll be taking you immediately after this break. So hang in there with us through this here on Dollars and Cents. This is Joel Garris of Nelson Financial Planning, News Radio 93.1 WFLA. Welcome back, ladies and gentlemen. We're going to go straight to the phones here on Dollars and Cents with Joel Garris of Nelson Financial Planning. Skip was kind enough to hang on through the break. We appreciate that, Skip.
Okay. Joel, I listened with interest to your description of the guaranteed annuities, guaranteed return annuities. And if I had to use one word to describe what I just heard, it would be scam. Now, that's my words, not yours.
Correct.
And my question is, if, in fact, these things are so bad, why does the SEC allow them to be sold?
Great question. And here's the biggest problem with them. Some of the most popular ones, particularly the equity index annuities, are not governed by the SEC. They are, in fact, insurance products. And those insurance products are, in fact, state regulated. And that's where the problem comes in, because the state of Florida does not have the resources to devote, and the disclosure is simply an oversight, just simply isn't as great if it were a investment that was regulated on the federal level. A little bit of an end around by the insurance company in coming up with these fixed these equity index based type products is they make the investing public sound like they're getting something that is market based. The reality is it's very specific in how it's created to avoid oversight by the SEC and FINRA as well.
Okay. Is there any circumstance at all that you would advise buying one of these products?
Yes, of course. I mean, I think obviously when we talk about on the program, we talk about generalizations, and I think I'm pretty confident on the generalization. Is there any extreme set of circumstances where you could perhaps justify?
I didn't say extreme, but
no, generally no. I think it's a worst case. It's a worst product, and at the end of the day, the investor is just paying through the teeth. I mean, might there be some extreme set of circumstances where you would say, well, okay, well, for this person, it's the right thing to do. Someone who is, say, single, incredibly nervous about the market, wanted a steady stream of income. I mean, but that's a pretty rare exception to the overall public.
Okay. I have two such investments.
Gotcha.
They're not very large. They don't make up a large percentage of my total portfolio, but I have two of them. I've had them for about 7 or 8 years.
Okay.
How would you advise I get out of them?
Well, a lot of that is looking to make sure, first of all, that they're out of surrender. That's number one, and that's the first part, because you obviously don't want to have a huge cost associated with making a change. The other item is to sort of look at where you're at in terms of the tax implications. I mean, if there has been some profit in there, then to get out of them altogether is a little bit trickier. Are these after-tax money that you put in, or were these retirement account money you put in?
They're retirement account money. Let's see, they are after-tax money.
They are after-tax money. Okay, so you do have that tax issue to consider in terms of whatever money they're going to give you.
No,
Yep.
I'm sorry. I paid taxes on the money that I invested in these.
Correct. That would make them after tax. So
okay.
So whatever the profit is, then you would have to pay taxes on that to unwind those. So
okay. And if it were the opposite way, if they were pre-tax?
If it was pre-tax, you could move it over to an IRA and you wouldn't have to worry about any tax implications. Those are actually easier situations to deal with, because you don't have to worry about, if I cash this out, I'm going to have a tax implication. The reality is that if you shift it over to an IRA, then you do not have any of the tax implications that you would have on the after-tax one. So those are generally easier ones to deal with. Really, Skip, I encourage folks to really look at the fine print. If you've got an annuity, if you find that you have one, then I encourage you to really look at the fine print and try and make a determination as to, okay, here's the benefit that I got with this and what that looks like versus the potential implications of having to pay the taxes and having that money outside of an annuity. The one that we just dealt with this past week that kind of got me the topic for the show this morning, we actually learned that despite the fact that they had the contract since 2008, there was still a several $1,000s surrender charge on it. So obviously on that we delayed until such time as that is out of surrender. But that was an IRA, and those are easier to deal with in terms of avoiding the tax implications. So Skip, I'd encourage you to visit with someone, sit down, and kind of go through what the bells and whistles are, and try and make as informed decision as you can on it. I would argue that you made a mistake getting into them in the first place. We don't want you to compound that mistake without doing an analysis on that. And of course, happy to sit with you and visit with you at the office as well on those two.
Okay, thanks a lot.
All right, thanks, Skip. Thanks for that call. We will hopefully be able to assist. The reality is that you really do want to take a hard look at those types of products if you find yourself in one, to really compare, okay, what's the impact going to be if I sort of unwind this thing, and ultimately what am I giving up? And for that, you would also look at not just the tax implications, but how old you were. I mean, if you were older and trying to unwind, might be a little bit harder to justify that. I mean, there's a lot of sort of things and factors that go into that, which is why it really has to be done on a case-by-case basis. The reality is that the vast, vast, vast majority of times where we see these annuities, it is a situation where folks just did not realize what the full impact was of owning the particular product. And so those are the ones where you wind up having significant issues for the cost associated with making a change versus the lost opportunity. So an important discussion to have, and certainly for many of the folks out there that own them, you really want to make sure that you're understanding exactly all of the fine print and all of the decisions that have anything and everything to do with making that decision. You certainly don't want to compound one mistake by having a second mistake on that. And there's a lot of features to them that require you to look at them very, very closely. There should absolutely be, Skip, as we were talking, there should absolutely be a higher level of regulation on these products, these pure insurance products that are out there. There should absolutely be a higher level of regulation on them than there is. And unfortunately, there is a gap in the financial industry, and the insurance company has done a good job at staying outside of that fold, whereby they are simply not subject to the same level of SEC and FINRA regulation as a pure investment product would have. But they certainly have done a great job marketing that they are, in fact, market or equity based. It's fascinating, and I'm not sure how. Well, I know how. The insurance company has a much more powerful lobby than we all realize. That is for sure. Anyway, the music means we're going to wrap it up for this week. We thank you all for listening. We thank the callers for calling on in, Skip and Bernie, and giving us some additional topics for the program. Like we said, we've got a video of this program that we will be putting up on the various YouTube channels and the like under Nelson Financial Planning. We'll have that up tomorrow, and then the audio we'll put out as a podcast as well at any number of the podcast channels that you'll see if you go to our website at nelsonfinancialplanning.com. We hope you enjoy your day, and we will enjoy ours as well here on Dollars and Cents. This has been Joel Garris of Nelson Financial Planning on News Radio 93.1 WFLA.